Most people who start a business believe that forming an LLC is the smartest financial move they can make. And honestly, in many ways, they're right. But here is the thing nobody tells you when you sign up for that LLC. By itself, it does nothing to lower your tax bill. And if you are not paying attention, that single misunderstanding could cost you $10, $20, even $30,000 every single year. I know that sounds dramatic. Stay with me, because by the end of this video, you are going to understand exactly why this happens, who it affects the most, and what you can actually do about it. Let me start with the biggest misconception floating around the business world right now. When most people form an LLC, they assume it comes with some kind of built-in tax advantage. Maybe they heard it from a friend, saw it in a YouTube comment, or read a blog post from someone who sounded like they knew what they were talking about. But here is the cold, hard truth. The IRS does not even recognize an LLC as a distinct tax category. Think about that for a second. The entity that millions of entrepreneurs rush to create the moment they start making money is essentially invisible to the IRS from a tax standpoint. So what does the IRS actually do with your LLC? It falls back on default rules based on how many owners you have. If you are the only owner, congratulations, you are being taxed exactly like a sole proprietor. Same forms, same treatment, same tax burden as if you never formed the LLC at all. Now that does not mean the LLC is useless. It genuinely does provide real benefits like legal liability protection, separation of personal and business finances, and increased credibility when dealing with clients and lenders. Those things matter. But none of them put money back in your pocket on April 15th. Here is where things start to get really painful. When your business income grows, you run directly into something called self-employment tax. This is the tax that covers your contributions to Social Security and Medicare. Now, if you have ever been an employee somewhere, you know that your employer splits this cost with you. Half comes out of your paycheck and the other half comes from your employer. But when you are running your own business through a default LLC, you're both the employee and the employer. That means you pay both sides. The combined rate sits at 15.3% and it is calculated on about 92% of your net business income. Now here is the part that catches people completely off guard. This tax hits you before federal income tax, before state income tax, before most deductions even come into play. So by the time you are doing the actual math on what you owe, you have already taken a massive hit that most people never plan for. Picture someone running a consulting business and pulling in $120,000 in net profit. Sounds great, right? But once that self-employment tax calculation runs its course, they're looking at somewhere around $17,000 gone before anything else is even touched. Add in federal and state income taxes and that person could easily lose $30,000 to $40,000 in total taxes for the year. That is not a small number. And here is the part that makes this even more frustrating. This is not a punishment for doing something wrong. This is just what happens when a growing business stays in the wrong structure too long. As your profit climbs, your self-employment tax climbs right alongside it with absolutely no natural limit built into a standard LLC setup. Many business owners start noticing that the harder they work and the more efficiently they run things, the bigger the tax bill gets. It starts to feel like the tax code is working against you. And in a sense, if you are in the wrong structure, it really is. So what is the actual solution here? There is a strategy that has been sitting inside the tax code for decades that most small business owners either do not know about or have been told is too complicated to bother with. It is called the S corporation election. This is not a different business entity. It is a tax classification that you can apply to your existing LLC. Once you make this election, something powerful changes in how your income gets categorized. Here is how it works. When your business is taxed as an S corporation, you split your income into two buckets. The first bucket is your salary, the money you pay yourself as a W-2 employee of your own company. That portion is still subject to payroll taxes, just like any regular job. The second bucket is called a distribution. This is the remaining profit after your salary has been paid out. And here is the key. Distributions are not subject to self-employment tax or payroll taxes. That distinction alone can save thousands of dollars every single year. Let me run the numbers so this becomes completely clear. Say your business brings in $130,000 in net profit. As a default LLC, nearly all of that is hit with that 15.3% tax, leaving you with an $18,000 self-employment tax bill before anything else. Now apply the S corporation election to that same business. You pay yourself a reasonable salary of $65,000. That salary goes through normal payroll taxes. The remaining $65,000 gets paid out as a distribution completely free from those payroll taxes. The result is roughly $8,400 in savings, and you did nothing illegal, nothing aggressive. You simply used the structure the tax code already provides. Now I know what some of you are thinking. If this is so powerful, why is nobody talking about me about this? The honest answer is that most accountants are focused on making sure your returns are accurate and filed on time. That is compliance work, and it is important, but it is not the same thing as strategic tax planning. If your accountant has never brought up an S corporation election in the context of saving you money, you may be leaving a significant amount of cash on the table every single year. So when does the S corp election actually make sense for you? This is a fair question because there are real costs involved in setting it up and running payroll properly. Generally speaking, the strategy starts making financial sense once your business is consistently generating somewhere between $50,000 and $60,000 in net profit annually. Below that level, the administrative costs can eat up the savings. Above it, the savings start outpacing the costs by a meaningful margin and continue growing from there as your business scales. The longer you wait to make this transition, once you have crossed that threshold, the more money stays in the IRS's pocket instead of yours. Some business owners go years in the wrong structure simply because no one told them there was a better option. That is not a failure of effort. That is a failure of information. Here is what I want you to walk away understanding today. Revenue is just one half of the wealth equation. Strategy is the other half. Growing your income without adjusting your tax structure means a larger and larger percentage of everything you earn goes to taxes that could have been legally reduced. An LLC is a great starting point. For many early-stage businesses, it is exactly the right move. But as profits grow, your structure needs to grow with you. If you have been running your business through a default LLC and you have not had a real conversation about your tax structure with someone who focuses on strategy rather than just compliance today, is a good day to start. Check your net profit, understand where you stand, and find out if an S corporation election could be working in your favor right now. The tax code is full of tools designed for exactly this purpose. The only question is whether you are using them. Like this video if it gave you some clarity. Drop a comment below if you have questions about your own situation, and make sure you subscribe so you do not miss what we are covering next.